Good morning. My name is Orly Renat, and I'm proud member of ICON Steering Committee and EC Committee. ICON is a non-profit organization aiming at bonding the Silicon Valley Jewish community around their passion to support Israeli entrepreneurs in their global expansion. We're living in unusual times where we are experiencing unprecedented changes. Over the last few weeks, the financial markets, the social platforms, and the government had to deal with profound impact of these changes. We are fortunate to have Dovi Francis to interview Alex Sompel today. Dovi Francis is a colleague of mine from the ICON committee. He is the founder of Rookie 11, a Los Angeles-based venture capital firm with investments in financial technology companies such as Tipalti, Trip Action, Sunbeat, and Next Insurance. Dov is also one of Shark's investors on the Israeli versions of the reality television series Shark Tank. Alex Sompel is a general partner at Anderson Horowitz, where he focuses on financial services. Alex led and served on the boards of numerous investments, including Open Door, Plaid, Quantopian acquired by Robinhood, and Rival acquired by Live Nation, to name a few. Alex co-founded multiple companies, including a firm, Found Eliminator, acquired by McAfee in 2006, Point Triple Trial Pay, acquired by Visa in 2015, TXN, acquired by Investance in 2019, and Yab, acquired by Coupons.com in 2013. Currently, he's investor and board member at Brand.co, Cross River Bank, Quantopian, Peer Street, Open Invest, Popper, TransferWise, Open Door, Flyhouse, Loft, Descript, Health IQ, Point, Popper, and more. And now I'll let Dov and Alex.
Yeah. Thank you, Oli, for this beautiful introduction. Let me just make sure that the Clubhouse room is active, because mine shows that the room hasn't.
It is, yeah. It should be learning from the Gamestop Saga sound mirroring.
Apologies. We need another minute.
Yasmin invited me in.
But the room hasn't started yet.
No, it has.
We hear you with an echo, by the way. Yeah. Okay. Well, mine hasn't started, for whatever reason. Okay. Yasmin, you want to send me the link so I can just join directly?
Alex, you can unmute when you're speaking here if you want. I know you're trying to help Dobby set this up and get this. Here's Dobby. Great.
Okay, I think now it's. I think now it's okay.
Dobby and Alex, I need you to unmute when you speak.
Okay.
Again, you can unmute when you speak.
Okay. Lots of technical difficulties here. Let me see if it works. How about that? I'll do it only from the streamer and the room at the same time. Alex, is that okay with you?
That sounds good.
All right. And if we see that things are not going well with the streamer, we'll abandon the streamer and we'll stay in the room. Alex, good morning. Well, we're summoned here today to talk about the GameStop saga, but I think this conversation will extend to other things, stranger things that are happening right now. And maybe just to kick things off, if you don't mind, and I've seen you've written a bunch about the very same topic, would you mind taking the audience in 2-3 minutes through what has happened with the GameStop stock, essentially since, I don't know, let's say early January. Around January 13, and to this very moment, and from there we can ask some other questions.
Sure. Sorry. Say that one more time, because there's a mic issue.
Oh, all right. So I was asked. Can you hear me now? Yeah. All right.
Yes.
So I was asking if you don't mind, just to kick things off, maybe we can start with just talking about what has happened with GameStop essentially since January 13th to this very moment. And then I'll ask you some, follow-on questions on what has contributed to what has happened with GameStop. But let's just start with kind of like going through the series of events that has taken place.
Sorry. Sure. I mean, so probably the best way of explaining what happened is if you go back to the beginning. GameStop was a company. Sorry, there's an echo. Can you mute on yours, Jovi? There we go. So I'm sure a lot of people here know GameStop. GameStop is a retailer with 5,000 plus stores around the country, and kind of its heyday was many years before, which was you wanted to go buy a video game, you went to a store, you bought the box, you bought the CD, you bought the DVD, and then you went home, and that's how people used to buy video games. And it's been having challenges lately because now you have things like Steam or Valve, or even my kids have a Nintendo Switch and they want to get a new game, they just download it directly. So GameStop's been struggling a little bit to find their way, just as many other retailers have in the era of the internet. So this summer GameStop was down to about a $300 million market cap, just because the company wasn't doing great. And a lot of times what happens is when companies are not doing great, they attract, and they're public, they attract funds that short them. And just to give some definitional background, normally when you invest in the stock market, your goal is to buy low, sell high. That kind of makes sense. You buy something for $10 a share, and then if you sell it for $30 a share, you make a profit. Shorting works the opposite direction, which is you try to sell high, buy low. And it's effectively betting that something will fall in value. So what are things that people like to bet on that will fall in value? Sometimes people will bet on things that seem overpriced, but that's a very, very difficult bet to make, because what's overpriced, what's underpriced, sometimes the market sentiment changes. A lot of firms, and these are normally hedge funds, because a hedge is basically I'm buying some things, I'm selling other things. So I'm trying to be almost neutral relative to which way the market goes. So a lot of hedge funds, they'll buy lots of things, they'll short a smaller number of things, and that's how they'll try to neutralize against certain market changes that might go against them. But the things that they often try to short are things that are kind of going against the arc of history. So, Sears it's not like Sears was overvalued or undervalued, but it looked like, wow, Amazon's going to crush that Sears company. So no matter what the multiples are in the stock market, if I bet against Sears, that seems like a good bet to make. Like that's what a hedge fund might think. So anyway, there were a lot of hedge funds that were short GameStop, but GameStop only had a $300 million market cap. But the most money that therefore these hedge funds could make is, call it the entire sum of that market cap. And then what happened was there was a whole army of people. And actually, it wasn't just an army of normal people. There was a guy that started a company called Chewy, which was a very successful pet food retailer that is now public again. I think it merged with Petco or something, but sold this company Chewy for $3 billion. He became a big believer in GameStop, bought a big chunk. And then you had all of these people on Reddit buying and saying, we're going to make money effectively by buying GameStop stock. And what happens, and this is what kind of led to this kind of craziness, is when you're short a stock, you can lose unlimited amounts of money, because again, you're selling high, hopefully buying low. But what if the price goes up? Because like the nice thing is that if I buy a stock for $10 a share and it goes down to zero, well, I lost $10 a share. That's unfortunate. I lost all my money, but I can't lose more than all of my money. If I short a stock at $10 a share and it goes up to 20, it goes up to 30, it goes up to 40, it goes up to 100, it goes up to 200, I can literally lose unlimited amounts of money. And my broker normally won't let me do that. They'll say, wow, like this, you have to buy back this stock because you sold not high. Turns out you sold low. It keeps going higher. We're getting very nervous because we are borrowing this stock from somebody. We have to return it to them. You don't have enough money to do this. We're going to mandate that you buy it back right now. So this is what's called a short squeeze. And a short squeeze is effectively, it's almost a forced rebuying of the stock by the shorts. And there's a term called short interest, which shows what percentage of all shares outstanding of a stock are sold short. And the crazy thing is that for GameStop, it was actually over 100%. And I'll explain how that's possible in a second, but basically every single share of GameStop stock and then some had been borrowed by somebody and then sold. That's what selling short is. And then as the price kept going up, why did the price keep going up? It's like a lot of these Redditors were buying, or a lot of these Redditors were buying options, and the options were, and when you buy an option, somebody sells you an option, in many cases, they need to hedge their position themselves by buying the underlying stock. So basically what happened was you had a ton of short selling in GameStop. So it was very primed for what I would call a short squeeze. Then you had Redditors and non-Redditors alike that were buying GameStop stock, which was not normally seen as a great, most super prudent investment, just given the financial situation of the company and kind of where they're situated vis-a-vis the internet and whatnot. And then that caused the stock price to go up because, again, more people buying and selling, the stock price goes up. That caused a lot of the shorts to say, oh my God, like this price is going up, it should be going down, I've got to cover. When they cover and they buy back shares, that's buying. That causes the price to go up even higher, which causes other shorts to say, oh shoot, now this price has gone up too much, I have unlimited potential losses, I have to buy back. And that's what's called a short squeeze. So that's basically what happened.
Yeah, I'm unmuting on both sides. This is fun. Hold on. Yeah, can you hear me okay? Yeah. All right. Let's we'll put the technical aspects of short squeeze aside, and let's talk a little bit about the millennial traders. And as I said, Alex, I mean the conversation is going to take us to various areas of the economy. I hope you don't mind, but it's hopefully it will be interesting for the audience as well. So 2020 will go down in history as the year gave kind of like way for a global pandemic, but also the rise of the millennial retail investor. There is retail level interest and participation from this new class of investors comprise almost 26% of the stock market today. According to the SEC, in 2020, American households own $29 trillion of equities, which is more than 58% of the US equity market, either directly or indirectly through mutual funds. What, in your opinion, brought to this tipping point where we see this participation of millennial retail investors? And what do you think are those special attributes that those people possess that allow them to unionize in the way they did with Reddit? That, by the way, I mean, that particular page has more than 9 million followers, right? So obviously can cause some upswings in the market, especially around stocks with small market cap.
Sure. So I'm going to double. The trick is we have to mute or unmute both at the same time. So I've learned that now. That's my key learning from today. So just taking a step back, I think it is fundamentally a good thing for more people to invest in the stock market. I mean, the stock market, it goes down a lot, it goes up a lot. But if you look over the long term, I mean, if you look since, for the last 100 years, since 1921, I think the stock market has compounded at like something like 9% every year. Whereas cash loses value. So what if you just held a $100 bill in 1921, which would buy you a lot of things in 1921, that $100 bill would buy you substantially less today. So, it's well understood that inflation is not your friend. And the best way to avoid inflation, if you're in a hyperinflation country, you just buy assets, you buy goods and services before the money decreases in value. But, even better is you're buying productive assets. A productive asset would be, call it shares of stock in some in a company. So I think fundamentally it's a good thing for more people to get exposure to the stock market. And I think most, whether you're even like the most diehard socialists would probably agree with that. So it's highly beneficial for people to have exposure. And I think what happened recently was sometimes interest in the stock market kind of waxes and wanes with the performance of said stock market. So like, bull markets, people get more excited because they hear about their neighbor buying a new house or this thing happening. Bear markets, everybody gets scared and kind of stays away. And that's typically been like kind of entrance and exit from the stock market or from investing kind of mirrors bull and bear markets. But, the other thing that's happened obviously in the last 20 years, but much more so in the last 10 is that now everybody has a phone. And it's much easier to, like, if I want to go check on my portfolio, I remember when I would do this as a kid, I got exposed to investing, and the newspaper would come out, of course, every morning. You'd go flip to the section that had all the stock prices. I don't know if you remember this. And everything was quoted in fractions. So it's like, oh, I wonder how much Dell is is trading at? Oh, it's currently trading at 23 1/8, like that. And that was like the closing price for the day. There was no way of seeing what's happening in real time. It just wasn't as fun or exciting. And then the commissions were very, very high. So what were commissions in the 1960s? I mean, it might cost you hundreds of dollars in 1960s money, which is like thousands of dollars today to go trade. A big revolution was with Charles Schwab. That was the first discount brokerage, where I think Schwab charged a mere $45 a trade in like whatever 1980s dollars, which is absurdly expensive to go access the stock market. So, the investing almost was a regressive tax. And what I mean by that is one of the things that really excites me about financial services is that they lower the cost of entry for lower income or lower wealth people. So I'll give you two examples of this. So number one is if I, like in the era of COVID, a lot of restaurants will not take cash because cash is dirty. It's true. Like I don't like handling cash. It is dirty. It probably spreads viruses. Can't prove that, but I would assume as such. It's not something you want to use. You want to do contactless payments with Apple Pay or Google Pay or pay with a credit card. And like all the restaurants that I go to, they ban cash. They only allow credit card and debit card payments. Well, that's great because I have 5 credit cards. It doesn't bother me. But if you're if you're low income, you can't get a credit card because you don't have credit. If you want to get a debit card and you don't have a bank account, your only option is to go to Walmart, buy one of those prepaid cards. I'm sure you've seen one of those before. And for the privilege of having a prepaid card, you pay $7.95 a month, regardless of the value of your balance. So again, I'm low income. I can't get a bank account. I can't get a credit card. And what I do is I go to Walmart, I put $100 into my prepaid card, and then all $100 of that will disappear, or $96 of that will disappear by the end of the year because I'm poor. That's what I mean by regressive tax. And trading and investing in the stock market often work the same way, which was, all right, $45 a trade. I only have $200 to my name. Should I invest in the stock market? Well, that seems like a very bad idea because I'm going to have a negative 22.5% return just based on commissions entering. And then if I need to exit, I'm going to have another negative 22.5% return. That seems like a horrible, horrible idea. So what happened, I was talking about the mobile phone as being one thing that really democratized this. The other thing that got rid of this regressive taxation system is Robinhood came around. And even before Robinhood, like Vanguard made this effectively free to buy into mutual funds. They really lowered the bar significantly. But if you wanted to buy individual stocks, so like I think that Apple's awesome, but Apple is at $100 a share and I only have $50. I can't buy one share of Apple because I don't have enough for one share of Apple. Like Robinhood did two things that were very interesting. One, they let you buy a fractional share. So they could say, all right, just buy $100 of Apple. It doesn't matter if the price of Apple is $10,000 a share. You're buying $100 of Apple. And they're keeping track of that fractional share for you. So that's number one. And then number two is they got rid of the trading commissions. And it turned out that none of the brokerages actually needed to charge commissions. I think for E-Trade and Schwab, commissions were about 15% of total revenue. So I kind of think of it as like baggage handling fees at the airlines. So if every airline is able to charge you $25 to check in a bag, nobody should exit that cartel. Because it's like, what are you going to do? Fly with your wings, like flap wings like a bird? Like you have to take one of these airlines, they all charge you $25 a bag. If somebody bails on the $25 a bag thing, like Southwest did, they might gain share. But nobody in this cartel of the brokerages said, we want to take fees to zero. Robinhood said, it's only 15% of revenue anyway, because normally brokerages, they make money on margin lending. They make money on loaning out your stock. They make money because market makers will rebate them part of the market maker's profits for executing trades. These were all ways that these companies, that all of the retail brokers like Schwab and E-Trade and Fidelity and Ameritrade made money. Robinhood said, hey, what if we take commissions down to zero and eliminate this regressive tax for entrance into investing? And that had a massive, massive impact because again, if you have $200, should you invest in the stock market? Unfortunately, the answer was no, because it would be all consumed with fees and commissions. Now the answer is yes. And now the answer as well is like, what is the best way to go invest? Now, there are some people that are investing in a very, very speculative way. There are some people that are just buying index funds. But I think overall, it's a net positive for more people to not just be holding, a $100 bill for 100 years, because I think mathematically that proves to be a very, very bad investment. It's better off if people have exposure to this broad wealth creation device called the stock market.
Okay, unmuted. Always takes a second. Yeah, you reminded me, Alex, of the good old days when I worked at Deutsche Bank on the trading floor, and yeah, we made good commissions back in the days. I kind of miss it. All right. So maybe what I'll do, I'll just take the question one step further, because you talked about the type of changes that have taken place through the introduction of smart devices and what have you. You know, we started with Schwab, Vanguard, then of course Robinhood, fractional shares, no fees, and what have you. I want to talk about the DNA of the millennial investor. I mean, that's what I was kind of like alluding to. I claim that those investors are different than us, or, you know, I was born in 78, so I guess 1980 and forward, are different than us in the way they consume information, in the way they interact with one another. They have the ability to interact with one another. We were more of white shoe investors back in the days. We were following the Wall Street Journal, we were following trends, we were following the charts. Most investors I see today that are millennial investors are following momentum. But not only they're following momentum, they're also following their profits. And many of them have profits. Some will call them false profits that they're following and they're advocating for and they admire. And on the list you have Elon Musk, who has, I don't know, 48 million followers on Twitter, last I checked, and Cathie Wood, that has, I don't know, she's growing nicely. She's getting close to, I think she's 600, 700,000 followers. You have Chamat, I cannot pronounce his last name for the life of me, who has 1.5 million followers. You have the Wall Street Bets founder, Jamie, who has more than 9.3 million people on Reddit. And they're holding status of celebrities. In fact, Cathie Wood is such a celebrity recently for the bets, bold bets she's made with Tesla and other stocks, CRISPR, etc. That you know, they're actually buying shirts with their face on the shirts, which you've never seen for a mutual fund manager. And we're also seeing that influence of those people in the price of Bitcoin, in the price of XRP, in the price of Dogecoin, and of course many stocks like Tesla that's trading at 1,200 times earnings. What, in your opinion, contributed to this huge kind of like followership that we're seeing, and the kind of like lines that have blurred between social media that used to be for entertainment only to the world of trading, and do you think that because the barrier of entry to become a trader has been eliminated, people who are were 13 and 14 can trade today, arguably. Do you think that we're seeing something that might threaten the stock market in the near future? Hold on, let me.
Yeah, it's a very good question. So I'll say a couple things. What I always find interesting is, we're on this app Clubhouse right now, and or at least we're mirroring our sound on Clubhouse apparently. So there's I think there's a publicly traded company called like Clubhouse something else. It has nothing to do with this Clubhouse. It's not related. And when Elon was on the actual Clubhouse app, like the fake Clubhouse, or maybe they would call themselves the real Clubhouse, like that stock went up. And why did that happen? Well, again, stocks only go up because more people buy than sell. It's just supply and demand. But is it because people were confused, or it's because people were buying because they thought other people would be confused? You know what I mean? So a lot of times, if Elon or somebody says something, I might not actually believe in anything that they said, but I might think that other people believe that thing, and therefore it becomes this self-perpetuating thing, or this self-fulfilling prophecy, as you would call it. So it's always hard to disentangle like why people do certain actions. I mean, I think fundamentally in a capitalist society, they're doing things because they think they'll make money. But is it because they're following the, as you said, the profit, not the profit with the F, but the profit with the PH? Or is it because they think that other people will follow the profit, and therefore they want to be a step ahead of that? And it's like, oh, well, every time that somebody says X, again, it's correlation, not causation, but when I see somebody say X, then Y happens. I don't actually believe that X causes Y, but I believe that other people believe that X causes Y. Therefore, I will do this particular thing, and that seems to happen a lot as well. But I don't know how much. I mean, the nice thing about, I can separate out crypto from, call it productive assets like stocks. I mean, if GameStop or United Airlines or Apple, it doesn't matter the company, if they run out of money and they cease operating, like the value goes to zero. And all of the retail investors or all of the profits with the PH in the world combined don't change that inexorable fact of it's like eventually these companies have to make money. If they make money, they survive. If they don't make money, they die. And they might get a longer lease on life if there's a certain amount of investor enthusiasm to give them capital. Because if you think about what happens when a company raises money, and again, public companies can raise money as well. They do a secondary offering or a primary offering. And they say, I'm going to sell shares to the public. When you do that, the treasury of the company keeps the proceeds. If you're losing lots of money and you have more money in your bank account, you have a longer lease on life. But again, it doesn't change the fundamentals of like this company is going to do well or poorly. I think what's happened a little bit, I'm going back to, I would actually say there were kind of 3 rounds of investing as I see it. Round 1 was actually, but maybe 4. Round 1 was like literally insider trading in like the 1920s. Like insider trading used to be legal in the US, or it wasn't proscribed. So people did that all the time. Nobody invested in the stock market except for like, rich people that now have streets named after them in New York, like the Vanderbilts or something. And like that was stock market investing. Round 2 was what I would call, was popularized by Peter Lynch, of the Magellan Fund, where he would do things like actual market research, like go to the JCPenney parking lot on a Sunday. It was packed. I should buy JCPenney stock. Like this was literally what he did. That became a little bit of an anachronism in the era of like, call it big data, where it's like now that happens, but like, I don't know, 2 Sigma probably has like real-time satellite photography of every parking lot on Earth and can figure this out at, breakneck speed versus Peter Lynch driving somewhere on Sunday. Round 3 was, it turned out that Jack Bogle was right. And that index funds actually are a superior investment instrument relative to active fund managers, or index funds beat the majority of fund managers and have lower fees. And, Vanguard Vanguard manages $5 trillion, so they must be doing something right. And round 4, I think, is what we're in right now, which is, it turns out that indices, yes, they beat most active fund managers, but it's a very, very blunt instrument. And it has 2 problems with being a blunt instrument. Problem number 1 is that it doesn't allow people to kind of vote with their dollars. So I hate United Airlines, but I love my Tesla. I want to swap out, I want the S&P 500, but I don't want to buy United Airlines because I hate them. And I want to have Tesla in there. Tesla now is in there, but Tesla wasn't in there until December. So how do I have like a smarter index? And then the other thing around it being a blunt instrument, and this is around beta, like I'm not trying to get alpha. Everybody wants alpha, which is kind of this, some information asymmetry in your favor that gives you a better return. I want beta. So, and what I mean by that is, if I live in the Bay Area, actually I wrote a fun blog post on this. My house is effectively priced in Facebook, Google, and Apple stock, right? So this is actually one of the bizarre things. If you look at housing prices in the Bay Area, have they gotten more expensive or cheaper? I would actually argue they've gotten cheaper for some small percentage of people. Because people that are paid in Facebook, Google, and Apple shares, housing has gotten cheaper for them because that's how they buy their house. They liquidate their shares, they buy the house. It turns out the shares have grown like 10x in value, and the house has only grown 3x in value. So guess what? The house is cheaper. If you look at it in US dollars, the house has gotten dramatically more expensive. So it just depends. It's a relativity question, right? So so what I would say is, like, we're currently in round 4 of investing. And round 4 of investing is, I think, popularized by low commissions, popularized by immediate access to mobile, popularized by like people just saying like, wow, I'm better off, not holding $100 bills in my Bank of America account, earning 0% interest. I'm better off potentially investing in things. I get this idea that I should invest in indices, but like I hate United Airlines, so I don't want to just like go buy more United Airlines stock by being in the S&P 500. What are the 5 brands that I love? And it's kind of like, Peter Lynch, but more personalized. And I think that's going to stick around for a very, very long time. And again, I think there's going to be some negative externalities here, which is like people will gamble and speculate, but there are different types of people that invest for different reasons. Like I think there are professional investors that are really just professional speculators. There's a really cool company called Common Stock. And what Common Stock does is it's almost like a Wall Street bets, but weighted based on portfolio performance. So you link your actual retail brokerage account, like whether it's Robinhood or Schwab or Fidelity or whatever, and then you'll advance some thesis about the world. Like, I think that Tesla's great, or I think that Tesla's bad, or I think that 1-800-Flowers is great, or whatever it might be. And the signal versus noise comes out based on your actual performance as an investor. So, the people that go there are ones that really, really like to think. I mean, it's like an old stock club. Like, I remember it in my school, we had like a stock market club, and we'd like, look at the newspaper and we'd circle the stocks with the fractions, and we'd buy and sell like on paper. How do you do that today? Like, there's a certain group of people that love that. They like to look at cash flows. They like to think about things like that. There's a certain group that says, all right, like, let's go speculate because that's fun. And there are hedge fund managers that do that too. There are people that just like to buy and hold and forget about things for 100 years. And they're the ones that will probably beat all of us. But they're just different types of people that like doing these different things. And I don't think there's one kind of catch-all for an investor in the year 2021, except there are a lot more of them. So therefore, each one of these buckets has been filled up even more than it was before. And I do think we're in this kind of like age 4 of investing, which is, indices are great, but they're blunt. And they're blunt both on the beta side, but also based on the personal preferences side.
Okay, muted, unmuted. Well, thank you. It's a great explanation. It's fascinating. Maybe I'll throw you a curveball. We'll it's easy to signal out the GameStop event itself from other weird, strange things that have happened in 2020 and going into 2021. So maybe just like a quick review of the strange things or the stranger things that have happened in the past few months alone. In a year, like in a year and a half, like we haven't seen since 1968, essentially. So we've had the COVID-19, obviously. We've had. By the way, I'm throwing them that without going through a linear timeline. Okay, but the storming of Capitol Hill, oil prices like jumping and dropping close to zero in April. The killing of George Floyd and the demonstration that followed. The signatures on the Abraham Accord. Joe Biden, Kamala Harris winning presidency. Bitcoin going from 5K in April to 55K, settling down around 50 recently. Dow dropping 40% from 29 to 18K, and then back to 30K in the course of weeks. And unemployment leaping from 4% to 16%, which we've never seen, and then settling back at 6%. And on top of that, just for fun and for good measure, flying car specs that are flying off the shelves. 551 unicorns with a combined market cap of $2 trillion, 10% of which were added in the past 60 days alone. And of course, the icing on the cake is the GameStop saga. So it's a strange question, but I'll guide you through it if we kind of like go off topic. But what do you make of all of this? We tend, as humans, I guess we tend to focus on a single event and just to try to rationalize it. But what if the GameStop saga is an interconnected event, like a computer network, like all of the other events that I've outlined? And if so, what is really happening here? Let me mute.
That's a big framing. It's really hard to say. I mean, I think there is a lot of interesting stuff happening. I mean, my view, and there are many views on this, and nobody knows unless you interview all 5 or 8 or whatever, 10 million people on Wall Street bets and whatnot. But I do think that fundamentally profit motives are pretty powerful. So like, there's this one trope that this is Occupy Wall Street 2.0. Where people said, screw the hedge funds, this is for you, dad, who lost your life savings in 2008 because of the evil banks. Like, yeah, maybe, but if it's like, okay, this is for you, dad, I'm going to light $100 bills on fire like the Joker in Batman or Dark Knight. I don't think there are that many people that do that. I think, again, I have no data to prove that or the contrary. I do think that there are a lot of people that want to make money. And it turns out that in a capitalist system, the most money goes to either people to whom capital is allocated or who allocate capital. Like that's really what works. I mean, and when actually I saw somebody comment here, like the Fed printed a lot of money. Absolutely. Like if you look at what happened, if you look at, and there's something called the St. Louis Fed website, it's Fred. And they have all these amazing graphs that you can look up, and you can look up, M1, which is like the one of the money supplies that's measured kind of like, money on demand accounts. And it's like, it went vertical. Like it kind of went vertical in 2008, but it really, really went vertical in 2020, 2021, because so much liquidity has been added to the system. And one of the things that's driving a lot of the things that you're talking about is, it's interesting to me, like when people measure inflation, they normally talk about what's called the CPI, the Consumer Price Index, and that measures a basket. It's like a Nielsen survey. It's like, okay, what do people spend money on? Well, they spend money on milk, they spend money on eggs, they spend money on gas, they spend money on all of these things. But many of them actually have deflationary pressures as well. And a deflationary pressure is if it turns out that somebody comes up with a, chicken egg sorting machine or a cow milking machine. Actually, there are such things. It's crazy if you've been to an industrial farm. It turns out that you can create a lot more productivity. So the dollar might be losing value because more dollars are available. People get paid more, not because their work is more valuable, but just because, inflation. But if you're able to produce twice as many eggs per hour, even if the value of a dollar halves, you can buy just as many eggs. Does that make sense? Like it's just kind of supply and demand. It's productivity gains. So that doesn't happen for assets. So and assets are appropriately not part of CPI because it's not like if I'm buying shares of Apple stock, like that's not part of my monthly expenditure. I don't have to buy shares of Apple stock. But asset prices have gone up a lot because the way that this money enters the system is the Fed doesn't just do helicopter money to consumers. They do helicopter money effectively to people that own assets. And they do this through the Federal Open Market Committee. So they'll go buy back bonds. They'll buy, like the Fed will increase the size of the balance sheet. This is what quantitative easing is. So the Fed will just put a bunch of zeros at the end of their Excel spreadsheet around how much money they have. Then they'll say, okay, we're going to use that money to go buy government bonds or buy mortgage-backed securities, et cetera, et cetera. And then people that own those things now have liquidity. They have more money. They use that to buy other assets. So it's basically you have two systems. You have normal CPI, which doesn't really seem to be changing that much because you have productivity gains in the in eggs and milk and whatnot, the things that normally go into the CPI. And then you have asset prices that have gone bananas. And then against that, you have interest rates that are 0%. Because the twin tools that the Fed has is it's we can cut interest rates. And if you look at why there are so many SPACs, it's very, very easy for me to explain to somebody why there are so many SPACs, which is it makes sense for people to invest in SPACs because right now my alternative is I earn 0% on my Bank of America account. I might as well just give it to everybody who's raising a SPAC because if I don't like the deal that they come up with in a year and a half, I get my money back. And my money back with no interest is the same thing as my money back with interest. And I get warrants maybe in this SPAC as well. A lot of them have warrant coverage. So should there be 10,000 SPACs? Absolutely. Can they find 10,000 companies to buy? I think unlikely. So, but that's a part of, so I think it really is a lot of these things are Fed actions where we have an economy that's struggling. You need fiscal and monetary policy, but monetary policy can't fix people being unemployed. But it's still a good tool to use to stop markets from not functioning. Some markets were not functioning in March and April. If you wanted to get a HELOC or a jumbo mortgage, that was really hard to do in March because, repurchase facilities, a lot of them were shutting down or not. Everybody was worried about liquidity. So people didn't want to go, they wanted to hold on to money and not loan money. So the Fed said, we're going to solve all these problems by doing all of these really, really amazing things to lower interest rates to zero and then buy every asset known to man, including things that they never did, buy corporate bonds, buy non-agency mortgages, buy all of these things just to inject more liquidity into the system. But I think the side effect of that is that you have the market that we're in today, which is 0% interest rates and lots and lots of cash out there that is looking for productive assets to go soak up. And again, that's where we are. So it's very, very different than interest rates are 5%. Why would I give my money to a SPAC where I'm probably not going to like their deal? Interest rates are 0%, sure. And that's just one of many, many examples.
Thank you. And yeah, I guess you can probably drill even deeper, right? And talk about not only government debt, but also the low birth rate that we're seeing, the deflation that is ensuing. People claim that there is an inflation. I think the contrary is correct. We can dive into that later, maybe if we have a little bit of time. But in 1752, Hume said when he was talking about public finance, he said, we've always found where a government has mortgaged all of its revenue, that it necessarily sinks into a state of languor, inactivity, and impotence. And there is something to be said about being at what, 130% GDP to debt to GDP, and that's kind of like the current ratio, which by the way has grown considerably over the past year with the CARES Act, the Family First Act, the payroll protection plan. I think it's like they added like 16%. 16% of last year's GDP alone were in these plans, and I'm not even talking about the unemployment compensation plan that is coming right now at, I don't know, $370 billion or what have you. So what do you think the future holds now that the U.S. government has done everything that is possible to ignite the economy? And do you think the economy will be ignited? Because there are some traditional industries that are being evaporated, right? Those are all of the industries that lie beneath the abstraction layer. And there are lots of industries that are taking place right now, from genome sequencing to robotics to software service, that are above the abstraction layer. So do you think that in the future we will see kind of like a snake that eats its own tail, or is the future a little bit different than what I'm envisioning?
You need a mute. Well, there are a lot of questions there. I'd say if I had perfect information, then I'd probably be in a different profession of being able to predict the future that accurately. But I'll say a few things. Number one, eventually we're going to get past this virus thing, or at least I hope. And there's a certain element where there's nothing that the Fed or the federal government can do to make people go take cruises on Carnival Cruise Lines if they think that cruises are bad for their health, right? Like, what's interesting about where the economy is right now is the government enacted lots of restrictions. And in some cases, the restrictions led to a cessation of economic activity. I mean, what's actually really interesting is a lot of people have more savings now than they've ever had in their lives, even though they're unemployed. And like, how do you explain that contradiction? Number one is there's stimulus money, and number two, there's nothing to spend money on. So, what do I do for fun? Well, I go to the bar, I go bowling, and then I go on a vacation. Well, I can't go to the bar, I can't go bowling. I don't do these things, but like, I can't go to the bar, I can't go bowling, and I can't go on vacation. Well, I might as well just stay in my house and watch Netflix, which costs, no matter how many movies I watch, the same, whatever, $12 a month. So there are some activities that people can't take because of government action. There are some activities because people can't take or don't want to take because their preferences have changed. So I think when the virus goes away, obviously part one is irrelevant, because people, like, I'm sure every nail salon will be open. I'm sure every bowling alley will be open. And I can imagine a world where people they have all this pent up desire to go bowl or something. And that's going to play out in spades, or go on vacation. Like, all that's going to play out. But then there are certain things that have probably changed, and there's no going back. Like, will business travel be the same afterwards? Like, I don't know. That's a very good question. People might realize that Zoom is a lot more convenient, or people might realize that they don't like Zoom and they want to go travel. It's very, very hard to see how that plays out. So I think that's one thing in terms of just predicting where and when the economy comes back. And then, there's another kind of thing that I'll add in there, which is there have been a lot of businesses that have been very, very negatively impacted by this whole thing. And I think there's been a certain amount of just, fundamental unfairness. And not intentional. I think it's just like kind of luck of the draw or unluck of the draw, which is like, Chipotle is doing great because they were able to invest in online ordering and put plexiglass in front of the ordering. I just went to Chipotle this weekend. It was like plexiglass everywhere, so that apparently I don't get virus and they don't get virus. And like, it's much harder for the local taqueria to do that. And then there have been many businesses like the airlines that have been bailed out by the government. There are many businesses that haven't. So there's a lot of after effects of this whole thing that I think we're going to deal with for years to come, because, of the 30 million small businesses in the US, like, how many of them have been impacted severely by this? Like, a lot. And I think many people appropriately so. believe that capitalism is meant to be survival of the fittest, but it's not meant to be you privatize profits and you socialize losses. And there's some of that which is happening. It's like, okay, well, if a business makes lots of money, well, they have to pay their taxes to the government, fine. If a business loses money because something bad happens, like nobody wants to take cruises anymore, well, the government will bail them out. Like that seems fundamentally unfair. So I think there's going to be some, there are going to be many layers of that playing out. But otherwise, like, I don't know, like it's just very hard for me to say like where things will go in a few years. But there's no question in my mind that we're going to have many, many lasting changes out of this. Like, education is one where I think there are going to be many lasting changes because there was a very, very funny meme that was going around that showed the price of different streaming services. I don't know if you saw this. It's like, Spotify, $10 a month, Netflix, $12 a month, Masterclass, $50 a month, Harvard University, $75,000 a year. Like, and it's like, if all you're doing is you're sitting at home and you're watching some guy or gal talk to you on YouTube, that seems like, it's pretty expensive to go pay $75,000 a year for that. Maybe I can pay $50 a year and get the same thing. So there have been certain changes, or like, telemedicine, massive, massive change. People have been talking about telemedicine for decades. And this is finally the thing that brought it over the line, where it's like, why would I go to a doctor's office to get my, whatever prescription refilled for my allergy medication and waste 2 hours of my time and 10 minutes of the doctor's time? Just do that electronically. And this was a very, very big forcing function to have that change. So I think there have been a lot of changes like that are hopefully irreversible for the better, where it might have otherwise taken, it almost pulled forward the future by maybe a decade.
Thank you, Alex. Yeah, interesting. You were talking about healthcare. I was thinking about that service forward, where you go into the clinic and they have that machine that basically measures all of your vitals and everything is like streamed into the cloud. And yeah, medicine should look differently, and so will education, I'm sure, over the next few years. Fine, we're going to conclude soon, and so I want to answer some questions from the audience, I guess, or we can invite people into the room, whatever works. I don't know exactly what Yasmin wants us to do. I will say, Alex, just on my last question, I think that everything that you have outlined in the short term, will surely take place. And I'm not trying to be a prophet or to predict the mid kind of like the mid future. But I would say that there is confluence of factors that are kind of like touching one another. They're not disjointed from one another. So that's demographic changes. These are technology changes. It's mounting debt. I think debt is currently $230,000 per taxpayer, and I think that the combination of those three. Just speaking of demographic, we're not having kids anymore. There has been, like, last year 1.2% of global population growth. It's in the US it was 0.48%, which is kind of like interestingly similar to what was in 1917, just before the Spanish flu. So between not having kids, having lots of debt, having a huge production gap, and consumption consumption is changing accordingly, and I think that will put lots of pressure on the economy in the coming years, and eventually also on the technology sector. We're not seeing it right now, but the same things that we revolutionize and change and disrupt, those things that kind of like fall beneath the abstraction layer, will be eventually the same things that will make us slow down the pace of growth. Questions from the audience. Let me see here. Yeah, so Erez is asking, what is the future of AI trading? We'll do like a lightning round. We'll do like 1 minute per question. You ready? So let's do it. What is the future of AI trading, Alex?
That one, I wish I had a better answer. I don't know. There's a ton of that happening right now. This is effectively what, in my opinion, Renaissance Technologies and others have done for a very, very long time. So you have all these machine learning models that just do things and you can't explain why. It's just a complete black box. So it seems like it's working out pretty well for them, and others, it's probably one of these. Don't try it at home yourself if you're a random person, because you're going to get outgunned by people that have more data.
Okay. Next question is for Maya, and she's asking, when the interest rate is 0, where will you put your money if not stocks?
I just try to not hold cash. That's my cash is guaranteed to lose value. Everything else at least has a chance to lose value. Like somebody that I know well says there's no such thing as equities. There are only bonds and call options. So call options are pretty self-evident or self-describing, and bonds are bonds. So, I think of even overpriced equities as being call options on like these things might be dominant platforms in the future. But the only absolute way to lose money is to hold cash in perpetuity.
Yeah, agree. And there's some great interviews with Warren Buffett and Charlie Munger just about that, right? I mean, Buffett just hates bonds, and he's always hated bonds. Next question is from Idan, and he's asking, will you agree that there are too many overvalued stocks in the market due to these new platforms? There is a question here about also he's asking about Tesla with a PE ratio of 1,200, which essentially means it will take 1,200 years to get to the valuation in terms of the revenue pace. So what do you think about that?
I'm not an expert in any of these things. I invest in private companies that are often two people in a garage that have a PowerPoint presentation. So it's hard for me to weigh in on anything else. I'll say that I think what people like, this has been a very, very bad decade for what is called value investing, where you invest in the fundamentals, because if something is cheap, it normally is cheap for a reason, and there's some adverse selection that you have to believe into. Whereas the best returning things for a very, very long period of time have been things that are expensive because, again, positive selection bias. It's you're betting on the future as opposed to you're betting on cheapness of the past, or like the glory of the past. Like IBM is cheap, GE is cheap, but what are they doing that does it seem like they're going to be the dominant platforms of the future? Like, I don't know. But I think that's the thing that the one way to also have lost money, if you look back over the last couple decades, has been the value investing trap, where I just think that got arbitraged away. Like that was something that you could do very, very well in the Benjamin Graham era. Value investing worked because markets were inefficient. As markets got more efficient, things became kind of more like, it was just hard to make money on that thesis. It's also hard to make money saying, okay, this thing is trading at 1,200 times current earnings. But no, it's not. It's trading. I mean, if you have smart people that are investing against that, they're like, well, we think that in 10 years, it's going to be 100 times bigger. And I think that's very much a venture capital lens, which is a lot of times people, they overweight the present. They look at everything based on like, here's what it looks like today, which is categorically the wrong way of looking at it. Which is why, again, you're not really buying equities, you're buying call options. You're saying, okay, here's what it is today. It's crazy, crazy overvalued by any sense of the imagination. Here's what it could be in the future. And it might not be that, but if it is, then maybe it's not overvalued. But again, a little out of my domain, unfortunately.
Yeah, we're doing it in the private market as well as venture capitalists, right? I mean, so it makes sense. Another question here that Joey is asking. He's talking about the recent restrictions we've seen on Robinhood and TD Ameritrade, etc., on certain stocks. And do you think that it will be allowed for brokerage firms to keep doing that, right? Basically, block certain trades or certain activity in certain stocks. And do you think it's morally correct to do?
Well, two things there. I mean, one is they always have the right to do that. But number two, I mean, it's in the user agreement that you signed up for, and it wasn't Robinhood, it was Fidelity and Interactive Brokers and Schwab. Every single broker did the same thing. But more importantly, like the reason why we have this is it's actually part of the law. It's part of Dodd-Frank. So when you go buy a stock, if you say I'm buying $50,000 of this stock, it takes 2 days. This isn't part of Dodd-Frank, but it takes 2 days for that securities transaction to clear. And then during those 2 days, your broker and their clearinghouse has to post collateral, because what if you don't show up with the money? Well, the seller might lose value because now the value of the stock that they're selling you might have fallen, right? Because the trade was supposed to happen today, but it's not going to clear for 2 more days. What if I don't show up with the money? But the broker can't use your $50,000 as collateral against the trade that you're paying for, which is crazy. So a lot of this, I mean, when you see the various people, again, well-intentioned, I think, in government saying we can't let this happen again. Well, the reason why it's happening to begin with is because of Dodd-Frank and laws that they themselves have passed. So ideally, any changes are based on like a full understanding of like how this stuff works. So I think it was a very, very spectacularly crazy case, which was the value at risk of a lot of these securities was deemed to be 100%. Because it's like, wow, this thing went up by so much, it could go down to zero. If it goes down to zero and then the buyer doesn't show up with the money, then the seller's left holding the bag. So therefore you have to post 100% collateral. And if you're clearing, many, many billions of dollars of trades a day, and this is why it was only buys, not sells. Like nobody was restricted from selling because you don't have to post collateral if you're selling something. You have to post collateral if you're buying something. So ideally settlement goes from a 2-day clearing window, which I think is absurd in the year 2021, to a instantaneous settlement. Like there's no reason why we can't do that. That would solve this problem immediately. But otherwise, more regulation to solve a problem that was caused by regulation doesn't make sense to me.
Thank you, Alex. All right, I think we're hitting. It's 10 o'clock, 10 a.m. Pacific. So, Alex, I really appreciate you taking the time to speaking with us today and answering some of my strange questions. And I appreciate the questions from the audience. Thanks so much, Icon, for facilitating this introduction. I encourage everybody who's not a member of Icon yet to join. Definitely an amazing organization. I'm proud to be a considerable sponsor and a board member. And that's it. Have a great day, everybody. We'll talk soon.
Thank you very much.